Hey guys, it's Sasha. The stock market is panicking because of interest rates, because of inflation, and because the stock market loves nothing more than to panic. In the last few days, the S&P 500 is down 4% from its high at the end of March. All because there is this new fear, old new fear that interest rates are not going to come down anytime soon. Last week, we got the March inflation data, which was higher than some analysts expected. That overall number, that is, because the overall number is being kept artificially high by high energy prices, the lagging shelter indicator, and car insurance companies increasing prices like a well-oiled cartel that they are. So inflation was a little bit higher than expected, and at the same time, some members of the Federal Reserve Open Market Committee were giving speeches in which they said that the Fed needs to be cautious, need to be wary not to cut interest rates too soon. So Wall Street took that literally and began panicking that there would be no rate cuts at all this year. Suddenly people are talking about big stock market crashes again. US economy will see more things break in 2025 if rates stay high. YouTubers are doing constipated faces all over again. The Fed seemed to realize that they need to calm things down. Maybe they went a little bit too far. So the Cleveland Fed president, Loretta Mester, came out earlier today to say that interest rates are going to happen this year, just not at the May meeting. Then the San Francisco Fed president, Mary Daly, said that 3 reductions this year is a very reasonable baseline. Then the New York Fed president said the same exact thing. But then just a few minutes ago, Jerome Powell came out and said that inflation is persistent. Rates will have to stay higher for longer. So the Fed doesn't appear to know at all what's going on. They're all saying the opposite of each other, and everyone is obsessed with exactly when the Fed is going to start reducing rates and what those rate cuts might mean for the stock market. Is the stock market going to explode when the rate cuts finally arrive, or will the stock market crash if the rates do not come down? Is there a big risk? Well, let's go through the numbers. Is the Fed running out of time? Now, I don't know about you, but I find it hard making time to cook. I work long hours, and after work, I don't want to go figure out what to cook, what ingredients I need to buy, go to the shop to get them, and this is where HelloFresh come in, who are the sponsors of today's video. My mum came to stay recently, so I got a HelloFresh box delivered while I was at work. All the ingredients are pre-measured, pre-cut, pre-whatever for the number of people that you want. All you need to do is follow the very simple instructions on the card, and hey presto, you've got yourself a meal for 4 in just 20 minutes. It's super convenient, and you get to cook a good meal without all the hassle and all the time spent before you actually get cooking. Get 60% off your first HelloFresh box, 20% off the next 2 months, and you get free dessert for life. Use my code FRESHSASHA, Y, all one word, or much easier, just click the link in the description or in the pinned comment. So when will the rates come down, and what will this mean for the stock market? First off, it's important to remember that Wall Street is extremely fickle. They change their mind all the time. Just because right now they think that rates won't come down does not mean jack shit in reality. Only 2 months ago, in February, the market put a 51% likelihood on the interest rate being 50 basis points lower in June. So 2 rate cuts at the next 2 meetings, or a big rate cut in June. Wall Street thought that there was a 39% chance that the rate would be 75 basis points lower by June. Today, that likelihood is 0. 2 months ago, Wall Street thought there was a pretty much 0% chance that the rates would not come down. And there is now a 79% likelihood of no rate cut in June or before, according to today's futures pricing data. So it's important to remember that these forecasts, these expectations, are not really based on data, because the data hasn't really changed. The forecasts are based on the emotional response of gamblers who overanalyze every single word coming out of Jerome Powell's mouth and do not analyze at all any data that is actually important. We've gone from an expectation of 2 to 3 rate cuts in the first half of this year to no rate cuts at all in the span of just 2 months. At the same time, it's important to remember that the Fed drives the economy by staring in the rearview mirror. The FOMC, that committee that make interest rate decisions in the US, is full of politicians in bankers' clothing. People who have no actual idea what it is the fuck that they're doing, who clearly don't understand how numbers work or how to do analysis. In the last 3 years, we've seen so much overwhelming evidence that conclusively proves this. So the Fed will not cut interest rates until one of two things happens. One, the overall rate of inflation comes down towards 2%, or two, the Fed is given a political carte blanche to drop rates because of a sudden change in sentiment, or the need for a sudden change in sentiment. According to recent polls like this one from the Financial Times and Michigan Ross, the majority of Americans disapprove of President Biden's handling of the economy, and they also disapprove of his handling of his job as a president. And we have an election coming up in November. It's really important to remember the political element of how this whole system works. I would not rule out that the numbers magically look bang on a lot better just before the September FOMC meeting, so that they can go ahead and do a rate cut a month and a half before the presidential election. Maybe address people's opinion of the handling of the economy. And it probably wouldn't take a lot for inflation data to suddenly begin looking good at precisely the right moment. The FOMC meeting is on the 17th and 18th of September. So the August inflation data will come out on September 11th. Exactly 1 week to warm up the media and for Wall Street to suddenly decide that there is a necessity of a rate drop if one hasn't already happened in June and July. Just look at the inflation data. If you look at the rate at which shelter is falling, it is almost exactly following rent prices with something like an 11 to 12 month delay. In the most recent Zumper report, rent prices are sitting at a 0% year-on-year increase, and they have been sitting there since September, but a year ago it was at 6.5%. And going back further, you can see that it peaked around April 2022 at 13 to 14%. Shelter inflation, the lagging indicator, peaked in March 2023, 11 months later, and now it's roughly halfway down to the 3% level at which it sat for a decade before COVID arrived. Just like a year ago, it was roughly halfway down from the peak to 0%. Data from house sales adds to that story. Everything is pointing to shelter coming down significantly at the end of the summer, going into September. And if everything else stayed the same, if the elevated energy prices stayed the same, if the elevated car insurance prices stayed the same, and shelter dropped to 3%, then inflation overall would be at 2.5%. And it would probably become untenable, if that was the case, for rates to stay at 5.5%, although who knows if inflation gets that low. Then remember that energy prices at the moment remain elevated because of the new risk of this broader war breaking out in the Middle East. We've never heard this one before. Oil prices back at $90, so there's going to be upward pressure on the April inflation data as well. And if the oil price does not drop back down, then May and June inflation numbers will also have energy pulling them up because oil price fell in May and June of last year. So when we're comparing year on year, we're going to be comparing higher numbers to lower numbers, and there's going to be a significant relative uplift on the overall inflation number just from the energy bit alone. But then in August last year, oil price went back up above $85 and it stayed there. So it's interesting because remember, August inflation data will be the last inflation data point before the September meeting of the Fed. And the stars seem to be aligning. Shelter and energy may be coming in with good numbers at precisely the right time. Natural gas prices have been on the floor for a while, so there's every chance that Biden's administration picks up the phone to the right people at the right time, and energy prices magically start falling from the ridiculous racketeering rates that are going on at the moment with low commodity prices but very high consumer prices. At the same time, the US economy behind the scenes is booming. Growth in the second half of 2023 was extremely strong, and the IMF says that the US economy will grow twice as fast as other G7 countries in 2024. They just increased their forecast from 2.1% growth to 2.7% for the United States this year. And this is a bit of a concern because the Fed keeps repeating that a strong economy and good jobs data is actually a really bad thing. Jerome Powell just spent 5 minutes a few minutes ago saying exactly this. I know. Because if they reduce interest rates, if the Fed reduces interest rates, then job data and the economy might be even better. It might overheat. Oh no, oh panic. And then everyone will look at the Fed if things actually get even better and say, well, what the fuck took you so long? But yes, the Fed has been using this excuse of jobs data and the economy doing well as the reason that there is no pressing need to reduce interest rates right now. But when the overall inflation numbers do dip below 3%, that argument may very well become irrelevant very quickly, because there will not be any practical reason to not allow the economy to expand even more if you can't pull out your inflation joker card. But the really important point really is why everyone is so obsessed with interest rates. Why? Because there are two sides to why interest rates are technically important here, right? The first is that high interest rates hold companies back from doing even better in terms of their own financials, not the commercial performance, but because high interest rates mean investments into companies are lower. Investments into companies are more expensive. It means that interest rates on company debt are higher, and it's more expensive for companies to borrow money to invest in new projects through debt. And at the same time, high interest rates make it harder for consumers to pay for interest on their debt. It means less people go out and spend money because they don't have as much money to spend. And of course, that means that companies don't make as much money. But then there's the second side to the coin, which is the company valuations bit. I've heard CNBC go overdrive talking about this point over and over, because the theory is if interest rates stay higher for longer, then the argument that some people on Wall Street make is that it reduces the value of companies because you have to use higher discount rates in the next 12 to 24 months. And if you use higher discount rates in the next 12 to 24 months, then everything that is further out than that has to be discounted by the interest rates to take you closer to the 24-month point, and then you discount it even more by the higher interest rates that you expect to be happening in the immediate future. So that means that when you do the discounted valuation models, you are going to be valuing companies less. But the reality is that there is no practical difference between a 5.5% interest rate or a 4.5% interest rate, because no person who is doing company valuations, no person on Wall Street is going to be really affected by this. A discounting cash flow model will be using much higher discount rates to account for opportunity cost instead of inflation, instead of interest rates. So people will typically use 10% or 12% or 13%, whatever they want. And that is the same as the numbers that people used before interest rates went down to 0% for the first time after the financial crash. Because the last 30 plus years, market opportunity cost has outpaced inflation and interest rates as the leading factor in setting discount rates. Why is this important? Well, it's because I think a lot of people care way too much about interest rates. In practice, the debt burden of the biggest companies in the stock market is actually quite low. Many of them carry no significant long-term debt or debt that is very easily managed. High interest rates affect the ability of consumers to buy products, but there is comparatively low direct impact on the company's finances through the rates themselves. Analysts say all kinds of shit on CNBC, but the reality is that these interest rates are not really affecting discounting at all. There is definitely some pressure from things like people choosing to park money in bonds because, high guaranteed yields. But here's a fun fact for you. The biggest bull run in stock market history happened in the second half of the 1990s, when interest rates sat between 5 and 6% consistently. A lot of people are sitting around trying to figure out when interest rates are going to drop, trying to time it perfectly by buying into stocks only when those interest rates start falling. Wall Street is obsessed with interest rates for whatever reason. But the stock market hit its all-time high 2 weeks ago because the stock market doesn't care what Tweedledums on Wall Street think. Will falling interest rates help the stock market do even better? Of course, it will encourage spending, which will improve performance. But when this happens, it will happen in addition to the economy doing really well already that we can see in the numbers. This will come on top of what we're seeing already. But I guess, better wait and see it play out first. Better be careful, because investing is all about staring into that rearview mirror, just like the Fed, right? Remember, go and get your 60% discount off HelloFresh, the sponsor of today's video, and see you later.